Accounting is often seen as a complex and intimidating field, but at its core, it relies on a set of fundamental principles and concepts that serve as the foundation for all financial record-keeping and reporting. In this video, we will discuss these accounting principles and concepts in simple language, making them easily understandable for everyone, whether you're a student, a small business owner, or just someone looking to gain a better grasp of financial matters. First principle, the accrual principle. Imagine you run a small bakery, and you've just sold a dozen cupcakes to a customer. According to the accrual principle, you record this sale as soon as it happens, regardless of when the payment is received. This principle ensures that financial transactions are recognized when they occur, providing a more accurate picture of your business's financial health. 2. The matching principle. The matching principle goes hand in hand with the accrual principle. It dictates that expenses should be recorded in the same accounting period as the revenue they helped generate. For instance, if you spent money on ingredients for the cupcakes you sold, those expenses should be recorded in the same period as the cupcake sale to reflect the true profitability of your business. 3. The going concern concept. The going concern concept assumes that a business will continue to operate indefinitely. This concept influences how assets and liabilities are valued. For example, your bakery's ovens are considered assets, and they are valued based on their expected useful life because your business is expected to continue operating for a long time. 4. The consistency principle. Consistency is key in accounting. It means that a business should use the same accounting methods and principles from one period to the next, ensuring that financial statements can be compared over time. Changing accounting methods too frequently can make it challenging for stakeholders to assess a business's financial performance. Before we discuss the next principle, please like the video, that will be helpful for this channel. Number 5. The Materiality Principle. Not every financial detail is equally important. The Materiality Principle suggests that only significant financial transactions should be recorded in detail. Minor expenses, like a box of paper clips for the bakery, may not need to be individually recorded since they won't have a substantial impact on your financial statements. 6. The Conservatism Principle. Accountants are encouraged to be conservative in their estimates and judgments. This means that when faced with uncertainty, it's better to stray on the side of caution. For instance, if there's doubt about whether a customer will pay a debt, it's wise to record it as a potential loss. 7. The Objectivity Principle. Financial statements should be based on objective, verifiable evidence rather than personal opinions or biases. For example, the value of your bakery's inventory should be based on its actual cost rather than what you think it might be worth. Number 8. The money measurement concept. Money is the common denominator in accounting. It means that only transactions that can be expressed in monetary terms are recorded. Non-monetary factors like employee morale or customer satisfaction, though important, are not accounted for directly in financial statements. Now move on to the conclusion. Understanding these accounting principles and concepts is like having a roadmap to navigate the world of finance. They provide a clear framework for recording, reporting, and interpreting financial information accurately. Whether you're managing personal finances, running a small business, or just curious about the financial world, these principles and concepts are invaluable tools for making informed decisions and achieving financial clarity. So, embrace them, and let them guide you on your journey to financial success. If you want to read it in detail or download the PDF, go through the link in the description, and don't forget to subscribe to Educationleaves.